Three companies that are often used as a proxy for the economy also posted their latest results today: General Electric, Caterpillar, and Honeywell. At GE, which is in the process of shedding assets from its GE Capital unit, adjusted profit edged out expectations. But there was concern that its organic revenue fell. Caterpillar missed on the bottom line, but its revenue beat forecasts, and Honeywell's results were better than expected thanks to growth in China. As you can see, all of those shares of all three finished to the downside. But as Bob Pisani tells us, it might not be the results that matter most right now. It might be the tone.
Three big industrials reported today, and there's been a subtle but important change in the tone from cautious to mildly more upbeat. Let's start with General Electric. They reaffirmed their full-year guidance. CEO Jeff Immelt was blunt in calling the oil and gas business challenging, but he also said the aviation business was seeing sustained strength and that healthcare was rebounding and that he was seeing improvements in our business in China. Overall, Immelt concluded there's plenty of business out there to achieve our goals. That's more positive than last quarter. Even companies that have had a tough time recently are modestly more optimistic. Take Caterpillar. It was not a good quarter. There were sales declines in all the key businesses, including construction and oil and gas and mining and rail. But CEO Douglas Oberhelman came on our air and said, overall, I think we are close to the bottom. Now, for a company that has seen declining revenue since 2012, saying we are close to a bottom, that's a definite change in tone. Then there's Honeywell. Earnings were up 9% year over year. That's good. Officials noted that growth in the key aerospace category had accelerated in the current quarter. Okay, so why were the stocks down slightly today? Because the stocks have had a nice rally since the February bottom, and they're expensive right now. Okay, so what does all this mean for the markets? There's a change in tone, however modest, and that's a good sign for earnings in the second half of the year, and it increases the chances that we can end this earnings recession, this 4 consecutive quarters of earnings decline in the S&P 500. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.